Other names like Telecom South Africa and Transnet that we didn't put on review. I think one of the key factors is the extent to which there are economic factors or macroeconomic factors impacting them, and the extent to which they are linked to state support and the reliance upon state support. So where we see strong linkages between the sovereign and sovereign trends in a state-owned entity, we do see a need for those ratings to be interlinked with that of the sovereign.
If they are so linked, why don't you just have the same rating? How do those ratings differ right now between the SOEs and South Africa?
Well, there are many state-owned entities whose ratings are at the level of the South African sovereign. So if you look at Transnet, for instance, its rating is at the level of the sovereign. If the sovereign rating were higher, Transnet's rating might actually be higher. So it's very much constrained. There are other state-owned entities like Eskom, whose rating is much lower because the standalone profile of Eskom is seen to be more challenged. And while they benefit from a level of support coming from South Africa, and therefore there are linkages because of the support that we expect and assume Eskom would receive, the rating itself on a standalone basis is substantially weaker.
So this is about whether the South African government can step in, basically, if these companies need support. Are you concerned that they are going to need more support in future?
I think that we do consider the need for support, and we consider the extent to which support is assured. Now, where there is a guarantee, there's an alignment of ratings. Where there isn't a guarantee, but there's expectations of support, we have to look at probabilities. And so we do assess a probability of support, and we're not saying that the state won't provide support, but we have to also signal to the market that in the absence of support, the rating and the default risk, because at the end of the day, what we're signaling with our ratings is the possibility, i.e. probability of default or possibility of default. We have to signal that with a lower rating to show that on a standalone basis, in the absence of support, there is a higher probability of default.
Let's move away from SOEs, but very quickly, when will we know that rating? Because you work differently to the other rating houses. There's not always a set time. You put these SOEs on review. When will the decision be made?
You know, I don't know the answer to that. I think some of those reviews are underway and have only just been announced. None of the names that I'm responsible for, my team is responsible for, on the corporate side are under review. It's more names in financial institutions and infrastructure in the case of Eskom, and there are very different reasons for those reviews. Some of them not necessarily directly linked to sovereign considerations, but others some linked to liquidity and the need for ongoing liquidity support. So I don't have a direct guidance. The reviews have only just started.
I was interested in what you were talking about, other companies, private companies as well, very linked to the fortunes of the country in which they're based. You were talking about Naspers. Just tell me about that link and how low growth in South Africa could affect the ratings of several companies.
Sure. I think that one of the questions we'd had from the audience was to what extent are ratings of South African corporates constrained by the sovereign, and when might the rating of a South African corporate be above that of the sovereign? I think the key message is that in situations where a South African corporate is highly diversified with operations and cash flows coming from outside of the country, or support coming from outside of the country, or investments outside of the country, and the example of Naspers with its substantial equity value and its publicly listed holding in Tencent gives it substantial flexibility to bring cash and access liquidity from outside of South Africa. So the linkages here are driven by the extent to which a corporate is directly linked to the same factors that might cause problems for the South African sovereign.
And finally, you were talking about the rand, our volatile rand. Has that been good or bad overall for corporates?
But this is a very interesting factor. Here, obviously, a weaker rand has negative considerations for people traveling and people, but it has been positive for exporters, and we've seen growth for the export economy. We've also seen companies in the metals and mining space, the gold companies, for instance, who generate cash flows from their exports in dollars because their pricing is in dollars, and therefore the weaker rand has meant that even as some commodity prices have fallen, so have the costs relative to the value of their exports, and so they've actually not suffered as much as companies who are coming from dollar-based economies such as North American mining companies. So there are benefits to a depreciating currency. We've seen that in Russia, where there is substantial benefit to exporters because they earned more on their exports. The key is whether that translates into inflation and other factors, but there can be offsetting benefits to currency depreciation.
David Staples, thank you very much.
Thank you very much.
Francis Hurd speaking to the MD of Corporate Finance at Moody's, David Staples.